Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're jumping into the second quarter 2025 results for Lindblad Expeditions, that's ticker LIND. They had their pre-market conference call back on August 4th. Our mission, like always, is to cut through the noise, pull out the key insights, and really give you the critical stuff that drove the market reaction and maybe a glimpse into where they're headed.
Yeah, and you could really feel the excitement around these results. The market reacted pretty enthusiastically. Shares jumped right away. So it definitely sets a positive tone for our discussion today.
Okay, so let's unpack that right away. What were the big numbers that got everyone talking?
All right, so Lindblad reported a Q2 GAAP EPS, that's a standard earnings per share, of negative $0.18. Now, that sounds negative, but the key thing is it beat the consensus estimate, which was negative $0.28. So that's a pretty significant beat, about $0.10 or 36% better than expected. Even being a loss, beating by that much, definitely turned some heads.
Right, a beat's a beat. And the revenue side looked pretty strong too, suggesting demand is definitely there.
Oh, absolutely. Revenue came in at $167.9 million. That easily beat the $159.2 million consensus by about 5.5%. And maybe more importantly, it's up 23% compared to the same quarter last year. That shows real momentum.
23% year over year, wow.
Yeah. And it wasn't just revenue. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, kind of a measure of core profitability. It surged up 139% year over year to $24.8 million. That's a huge jump, and it really shows their operational leverage kicking in.
Meaning, as revenue grows, costs aren't quite keeping pace, so more flows to the bottom line.
Exactly. It suggests they're managing costs well and using their ships efficiently.
And those operational metrics seem strong too. Net yield per guest night, basically how much they make per person per night, up 13%.
Yep, climbed 13% to $1,241, and occupancy hit 86%. That's up 8 percentage points from last year, which is quite impressive in this business.
Okay, 86% occupancy, 13% higher yield. How did these specific strengths connect to their bigger picture strategy? What did the CEO say about that?
Well, CEO Natalya Leahy directly linked that 23% revenue growth and the 86% occupancy to their strategic initiatives gaining traction. She laid out 3 main pillars they're focusing on. First, maximizing revenue generation, getting the most out of each trip. Second, optimizing financial performance, mainly through cost innovations. And third, looking for smart, accretive growth opportunities, so things that add value. Basically, these strong numbers give them the foundation, the confidence maybe, to push hard on these strategies.
Makes sense. They're building on a strong base.
Yeah.
It looks like they're investing in the people to make it happen too. New leadership hires.
Yeah, definitely. They brought in some heavy hitters, a new chief revenue management officer, a chief maritime officer, an SVP of planning and ops, and an SVP of strategy and corporate development. Bringing in that kind of specialized expertise, it signals they're really serious about execution on those pillars.
Right, these aren't just figurehead roles. A chief revenue management officer, for example, is key for pricing in a business like this.
Absolutely. And a chief maritime officer suggests a focus on efficiency and safety across the fleet. It tells you they're building the internal muscle to actually deliver on their promises.
Okay, so let's dig into that first pillar. Maximizing revenue. With occupancy already at 86%, how are they squeezing out more?
They're being pretty clever about it. One big thing is optimizing how they deploy the ships. They figured out ways to cut down non-revenue days, like time spent in dry dock, or repositioning by 38% between now and 2027. They did this just by smarter scheduling, essentially.
Turning downtime into sailing time.
Exactly. It effectively adds capacity without buying new ships. They even managed to add 4 extra voyages to the 2026 schedule just through better dry dock planning.
That's smart, getting more sweat out of the assets. And what about this onboard sales program? Trying to lock in the next trip while people are still on the current one.
Yeah, that's the idea. It's rolling out fully by the end of August. Think about it. You're on this amazing trip. You're buzzing from the experience. That's the perfect moment to think about where Lindblad can take you next. So they make it easy to book right then and there. It taps into that immediate enthusiasm.
Capitalizing on the moment. Makes sense. Drives reheat business. Extends how far out they're booked.
Precisely. It's much easier than finding a totally new customer.
And partnerships seem key too. The Disney collaboration sounds like it's really paying off.
Oh, big time. Bookings from Disney advisors are up 45%. But maybe the bigger deal is that Disney Vacation Club members can now use their points for Lindblad trips. That suddenly exposes the Lindblad brand to like over 250,000 DVC members.
Wow, that's a huge pool of potential customers already interested in quality travel.
Exactly. And they're seeing more multi-generational travel because of it too, grandparents taking the whole family, which ties into why they relaunched their youth program, Explorers in Training.
So catering to those families, what's special about that program?
Well, it's not just babysitting. It's designed to be genuinely educational. Kids get involved with the naturalists, learn about the environment. It's about fostering that sense of discovery early on, hopefully turning them into lifelong explorers, right?
Building the future customer base?
Yeah.
Smart. They're also using the National Geographic connection more.
Yeah, a recent digital and social media campaign they did with Nat Geo led to a 122% jump in search volume for Lindblad. Shows the power of that brand association. And they also made a splash celebrating their 2 new ships in the Galapagos, the National Geographic Delphina and Gemini.
How do new ships like that help the brand?
Well, launching state-of-the-art, purpose-built vessels in a key destination like the Galapagos gets a lot of attention. It reinforces their image as a leader, attracts discerning travelers, and justifies premium pricing. It's a tangible sign of quality.
Okay. And beyond the usual channels, they're pushing outbound sales and charters.
Right. Outbound sales efforts nearly doubled in Q2, showing good ROI there. And charters, like booking the whole ship for a group, are becoming a bigger piece of the pie. They said it's a double-digit percentage of 2026 bookings already.
Why is that diversification good for them?
It just makes their revenue more stable, less reliant on any one source. Charters often mean large chunks of revenue booked well in advance, which helps with planning and utilization.
Gotcha. And this isn't just ships, right? The land segment is innovating too. Women's journeys, chefs on wheels.
Yeah, they're tapping into specific high-end travel trends on land too. These niche tours, like women-only trips or cycling tours focused on food, cater to very specific interests. It lets them attract a dedicated audience and command premium prices for these unique experiences.
Okay, so that's the revenue side. Lots going on. What about Pillar 2, operational excellence and cost innovation, making the machine run smoother and cheaper?
Exactly. And this is crucial for profitability. They've got over 20 different initiatives going, things like optimizing port costs, smarter procurement, better crew planning. They're aiming for about $8 to $10 million in annual savings from all this.
Any interesting examples?
Well, they mentioned exploring renewable fuels, which hits both cost and sustainability, and using AI for crew scheduling that's pretty cutting edge, trying to optimize staffing efficiently. It's not just about cutting, it's about finding smarter ways to operate.
Using AI for crew planning. Interesting. And we already heard how better dry dock planning added voyages. How impactful is that really?
It's pure upside, essentially. Every extra trip they get from an existing ship, without the cost of a new one, flows almost straight to profit. It really shows how operational tweaks can directly boost the top and bottom line.
And they seem to be managing overhead well too. Even with more marketing, their SG&A costs as a share of revenue went down.
Yeah, down 190 basis points or 1.9%. That's impressive when you're also spending more to drive growth. And fuel costs as a percentage of their Lindblad segment revenue were down 230 basis points. It all points to pretty tight financial discipline and operational control.
Okay, which brings us to Pillar 3, accretive growth, looking beyond the core business.
Right, and the new European River Cruise program is a prime example. They said it's been really well received. 2026 sailings are already over 50% booked. Some are even sold out.
Wow, already. So clear demand for their brand on European rivers.
Seems like it. It fits their small ship, immersive style, just in a new location, tapping into a hot market.
And they also expanded in Africa, buying safari camps.
Yeah, they acquired 4 safari camps in East Africa. This is for their Natural Habitat Adventures brand, the land-based one. It's vertical integration.
Meaning they control more of the experience.
Exactly. They own the camps, so they can ensure the quality, tailor the itineraries, capture more of the profit. It gives them end-to-end control over that premium safari experience.
Let's look at the financials underpinning all this. Balance sheet looks healthy.
Seems pretty solid. Cash balance was up to $247.3 million, an increase of over $31 million since the end of 2024. Mostly driven by strong cash flow from operations, about $77.6 million generated. They did spend about $45 million on investing, mainly for those new Galapagos ships and dry docks we talked about.
So the core business is generating the cash they need to invest in growth.
That's the positive story, yeah.
And the net loss improved quite a bit year over year. But management called 2025 an investment year. What should we take away from that?
It's important context. They're signaling that they're spending money now, maybe on marketing for the new river cruises, staffing up, expanding internationally. That won't necessarily show immediate profit returns this year. They expect these investments to drive bigger growth and profits later on. So maybe expect slightly higher costs or less margin expansion in the second half, but view it as planting seeds for the future.
Got it. Investing for the long haul. And they're also prepping their first ESG report. Environmental, social, governance.
Yeah, due next quarter. They highlighted things like an electric vehicle for tourism they're using in Peru. For a company whose whole brand is about experiencing nature, this ESG focus is kind of critical, isn't it?
You'd think so. Their customers likely care about sustainability.
Absolutely. It's becoming table stakes, especially in the premium travel market. Being transparent about their efforts through an ESG report can be a real differentiator and aligns with their brand values.
Okay, expert, let's tie this all together for someone listening. Based on this strong quarter, Lindblad actually raised their full-year guidance for 2025. What does that look like now?
It's a pretty confident move. They bumped up the expectation for net yield per available guest night growth, now expecting 9% to 11% increase, up from 7% to 10%. They narrowed the revenue guidance range upwards, now $725 to $750 million. And importantly, raised the adjusted EBITDA guidance to $108, $115 million, up from $112 million before. That implies pretty solid mid-teens percentage growth continuing in the second half.
That's a strong signal. And it seems backed by actual bookings. They mentioned booking curves are ahead for 25 and 26.
Way ahead, according to them. And they've even opened up 2027 itineraries for sale now. Get this, they said last week was the highest weekly sales in the history of the National Geographic Lindblad Expeditions brand.
Highest ever. Wow. What does that tell you about demand right now?
It tells me demand for their kind of unique, high-end experiential travel is incredibly strong and sustained. It's not just pent-up demand anymore. It seems like a lasting trend. And that gives them huge visibility and, crucially, pricing power.
And the market noticed all this, right? Shares popped. Analysts reiterated buys.
Yeah, the reaction was immediate. Shares up over 6% pre-market that day. High volume, bullish options activity. Analysts at places like Craig-Hallum and Credit Suisse jumped on it, kept their buy ratings. They specifically mentioned pricing power and fleet leverage, basically. Lindblad can charge more, and they're getting more out of their ships. The average price target was around $15, implying, maybe 21% upside from where it was then?
So the market and analysts are buying into the growth story.
It seems that way. They see a company executing well in a strong market segment.
And it helps that the whole expedition cruise sector seems to be doing well.
It does. Peers are also reporting strong results, record yields. There's limited new ship capacity coming online in this specific niche. And the high-income travelers, who are their main customers, seem resilient, still spending on travel. So Lindblad is riding a strong tide, but also paddling very effectively themselves.
Okay, thinking longer term, what are the key things, the catalysts for investors to watch?
Yeah.
We heard about M&A benefits and the new ships adding significant EBITDA.
Yeah, those new Galapagos ships alone are expected to add maybe $40 million in EBITDA combined by 2027. That's substantial. Looking ahead, key things to watch would be an update on how those European river cruise bookings are really doing. Expect that at their investor day in November. There's a potential decision on a joint venture for polar aviation logistics, think getting people to remote Antarctic locations by early 2026. And then, how do bookings look for the peak Q4 holiday season? We'll get a sense of that early next year.
What about financially? Any big levers?
A big one could be refinancing their 2027 term loan. If their earnings keep growing like this, they might be able to get a much better interest rate, maybe save 150 basis points. That drops straight to the bottom line, improving net income significantly.
Now, some people did flag the debt level, 6.1 times net debt to EBITDA. Is that a concern?
It's definitely something to watch. That level of leverage isn't insignificant. But management seems confident. They've been redeeming some expensive debt early and even buying back shares. Those actions suggest they believe the company can handle the debt and that the stock is undervalued relative to future earnings.
So if they hit these milestones, strong river cruise bookings, successful new ship integration, maybe that refinancing, the story could change.
Exactly. The narrative could shift from, they survived COVID to this is a unique travel company that consistently generates strong cash flow and growth. and that could lead to a valuation re-rating. Right now, they trade at a lower multiple, like under 10x EV to EBITDA. If the market starts seeing them as a reliable compounder, they might start getting valued more like other small-cap consumer discretionary peers, which often trade at higher multiples. That's the potential upside investors are looking at.
Okay, right. Time for our segment where we put on our hypothetical hedge fund hats. Remember, this part is purely illustrative, absolutely not financial advice, just a thought experiment based on what we discussed.
All right, so given everything we've heard, the strong bookings, the expansion into potentially high-margin areas like river cruises and owning safari camps, plus that talk of a potential re-rating.
Yeah.
You could think about a long position in Lindblad, maybe even using long-dated call options if you have a higher risk tolerance and conviction.
Okay, so what's the core thesis behind that hypothetical trade?
The thesis is really a bet on execution. It's saying you believe they will successfully deliver on these specific growth drivers, that the European river cruise program will continue to book strongly, that the new safari camps will integrate well and boost margins, that the new ships will deliver that promise $20 million each in EBITDA, and that achieving these things over the next, say, 12, 18 months will force the market to recognize the value here and re-rate the stock higher, closing that valuation gap with peers.
So it's less about just the overall market lifting them and more about these specific initiatives driving a fundamental change in how Lindblad is perceived and valued, betting on their unique experience mode and transformation into a cash machine.
Precisely. It's a conviction play on their specific strategy playing out successfully and the market catching on. Again, just a thought experiment.
Got it. So wrapping this up, Lindblad delivered a really strong quarter, beat expectations, raised guidance.
Yeah, driven by solid execution on their strategy, getting more revenue, managing costs, and making smart growth moves.
And management's confidence, combined with that clear roadmap and potential catalysts, seems to paint a pretty compelling picture, which the market clearly responded to.
It really is a fascinating case study in leveraging partnerships like with Disney and Nat Geo, innovating on costs, and finding targeted growth avenues like river cruising and Africa. It shows how they're trying to shape their own future.
Indeed. It definitely leaves you thinking, doesn't it?
Wow.
Beyond just the travel itself, what's the long-term value the market assigns to these truly unique, maybe even life-changing experiences in a world that feels increasingly virtual? Something to ponder. Thank you for tuning into The Deep Dive. As always, dig deeper, do your own thinking, and join us next time.